6 weeks ago, the government rewrote the tax rules on property investment. And this week, the data is just in, and it tells us what that rewrite is actually doing to the market. Clearance rates below 50% for the first time since COVID. The largest monthly fall in national home values in almost 4 years, and every major bank cutting their price forecast in the same fortnight. That's the headline story. But there's a second number buried in the same data set moving in the opposite direction, and almost nobody is reporting on it. And I'm going to show you both on screen from the primary sources, not just my opinion. A quick recap on what actually changed, because the market reaction only makes sense once you understand the mechanism. Investors who buy established housing after the budget night will still be able to deduct losses against residential property income. They'll still be able to carry forward any unused losses to future years, but they won't be able to deduct them against other income like their salary. And from July of this year, if you buy an established property, any loss on it gets quarantined. It doesn't disappear. It carries forward for future rental income or eventual capital gain. It just stops offsetting your salary today. Now, the government will replace the 50% CGT discount with a discount based on inflation and introduce a minimum 30% tax on gains from 1st of July this year. Two changes, the same date, but the same trigger, which is established properties bought after 7:30 p.m. on 12th of May 2026. So pre-budget stock is grandfathered and new builds are untouched. That's a mechanism that's come in. Now let's look at what 6 weeks of that mechanism has actually done to the market. Cotality's National Home Value Index dropped 0.4% in June, driven by a 1.2% decline in Sydney home values and a 1% decline in Melbourne. Capital city home values fell 1.3% over the June quarter, led by Sydney down 3.2% and Melbourne down by 2.6%. That's a 0.4% in a single month. Sounds small? Well, it isn't. It's the largest monthly fall in the national index since December 2022, and it's concentrated exactly where you'd expect, the expensive markets of Sydney and Melbourne, the two markets with the highest concentration of established property investors. And here's where most coverage stops. Prices are falling, therefore the policy is working. Well, that's way too simple. Let's look at who's actually pulling back and why. The combined weekend capital city auction clearance rates were down to 47.4% in the last week of June. The first time since COVID, in April 2020, that auction clearance rates were below 50%. The first time since COVID, and Westpac's own economists put it plainly. Tax changes announced in the federal budget are set to drive a major shakeup, with investor demand now expected to see a sharp and sustained pullback from the mid-2026 region. The sharp and sustained pullback, now that's major banks' language, not mine. And it's not just sentiment, it's showing up in actual loan applications. ANZ now expects capital city house prices to fall 2.1% this year, and a sharp reversal from its earlier forecast of 2.8% growth. Westpac also reported applications for investor housing loans fell 20% in the 3 weeks following the May budget. 20% fewer investor loan applications, that's just huge. In 3 weeks, ANZ reversing an entire forecast from growth to decline in one budget cycle, and NAB's doing the same. This isn't a headline exaggeration. It's a documented shift in investor behavior inside 6 weeks. We now expect national dwelling prices to be flat over 2026, down from a forecast of 3% at the budget and 5% in March. CBA has cut its own forecast twice this year, first from 5% to 3% at the budget, and now 3% to flat. The same bank, the same year, but 2 downgrades. New investor lending is also expected to fall sharply over 2026, with loan volumes around half of late 2025 already, reflecting lower expected returns, tighter borrowing capacity, and more buyers simply choosing to wait and see. CBA's own economists expect investor lending volumes to roughly halve this year compared to last year. That is the single biggest number in the entire dataset. It's the one explaining the clearance rate, the price falls, all of it. Now here's the number nobody is pulling next to that one. The total number of dwellings approved fell 1.1% in May to 17,000. Private sector housing approvals rose 2.8% to the highest level since 2021. So read that again slowly. Total approvals fell because unit and apartment approvals dropped over 10% in the same month. But house approvals, the actual product Handle Properties buys for clients, to the highest level in 4 years. 4 consecutive months above 10,000. Builders are backing detached houses at a rate we haven't seen since 2021. In the exact month investor demand for established property is collapsing. Now, that is not a contradiction. That is the market repricing risk, not disappearing. So here's what this actually means if you're trying to buy or hold right now. And these are the 4 steps. And I'll show you the evidence behind each one. Step 1, negotiate, don't wait. Sydney's median dwelling value is 1.2 million, down 1.2% and down 3.2% on the quarter. A market with a clearance rate under 50% is a market where more vendors are missing their reserve than clearing it. That is the leverage for a buyer with finance sorted and a clear number in mind. Waiting for the bottom means competing against everyone else who waited, and the moment sentiment turns. So buying into the softness with a pre-approved, cash flow tested offer is how you use this window instead of losing it. Step 2, model the cash flow under the new rules, not the old ones. If you're buying established property after budget night, don't model your cash flow assuming you can offset a loss against your salary, because you can't. Not from 1st of July 2027, but model it as if the tax refund doesn't exist. If the property still stacks up on rent, vacancy, and the growth fundamentals without that refund, buy it. If it only works because of the refund, well, that's the definition of a subsidized bet CBA and Westpac are both telling you investors are walking away from. Step 3, get the structure conversation done now, not at settlement. Existing property owners, including those already under contract before the announcement, are grandfathered, and that can continue to access negative gearing under the current rules. But if you're mid-purchase or exchanging soon, that grandfathered protection depends on timing and contract status, not intent. So talk to your accountant about the entity, the timing, and structure before you sign. Step 4, where the supply data supports you, not where the headlines are. Every headline this fortnight is about Sydney and Melbourne, and that's where clearance rates are collapsing and prices are falling in concentrated measures. But that's also where investor exposure is the highest. Perth, Brisbane, and Adelaide are still recording price growth. Pair that with housing approvals data you just saw, while builders are backing detached housing at a 4-year high, disproportionately outside Sydney and Melbourne. The market the media is describing and the market with the strongest fundamentals right now are not the same. So 3 things to do this week. 1, get your borrowing capacity reassessed under the new rules, not the old ones. If your broker or lender is still factoring negative gearing into your serviceability for an established purchase, well, that number is going to be cut. Get a current figure so you know what you can borrow before making an offer. 2, if you're actively negotiating on an established property, use the clearance rate. A vendor in a sub 50% clearance rate market has more reason to meet you than they did 6 months ago. So don't just assume the asking price is the number. Step 3, stop reading the national headline and start reading the state and city breakdown. The market is falling is true for 2 cities, but it is not true for the other 6. Know which one you're actually buying in. At Handle Properties, we're a Sydney-based buyers agency. We purchase around 20 investment properties a month for our clients, and we operate in the price point of $500K to about $1.5 million. And this is where most of the quality stock is available in any given market at any given time. We are operating at this size by design. We are not a big agency and we do not buy at volume, because when you're a big agency, you have a big pipeline to fill and you can stop being selective. You buy what is available rather than what is right. We simply do not do that. And we are not a solo operator either, where you cannot match the agent relationships and off-market access we have built over years. That access is how we find deals before they are listed. So 20 properties a month means we are selective on every single one. If it does not meet our 30-point evaluation framework, we simply do not buy it. That is the standard our clients expect, and that is what we deliver. So if you'd like to find out whether Handle Properties is the right fit for your next purchase, head over to our website and book a free strategy call. The link is also in the description. And if you can, please follow us on Handle Properties on our Instagram and our YouTube for more videos like this.